How's it going, everyone? Today's podcast episode is going to be a little bit unique where we're actually going to read through a business breakdown. So, this breakdown is covering AppLovin, ticker APP, and it's a really interesting company. And I'm going to just sort of read through the breakdown and we can stop along the way, but we'll just see how this goes. So AppLovin, subtitle is The Ad Tech Benefiting from AI and the Failure of Competition. And we just released our Q2 results for Infused Partners, so you can check that out. I'll include the link to the business breakdown so you can actually read it if you'd like, rather than just listening, but a link to the quarterly letter there. But without further ado, let's just jump right in. So starting off with the background. Adam Foreffi founded AppLovin in 2012, but the company was officially out of stealth mode 2 years later. After graduating from Berkeley, Foreffi became a derivatives trader where he saw how data was being used at scale. But he always wanted to be an entrepreneur, following in his dad's footsteps, who had one of the largest construction businesses in Iran before the family fled to the US. After working at a startup called Claria, Adam's boss was leaving to start another business focused on marketing solutions for small to medium-sized businesses called LifeStreet. The business ended up doing pretty well, which gave Foreffi enough capital to start another advertising-related business called Social Hour before founding AppLovin. Having a deep knowledge in advertising and app development, AppLovin was focused on getting more installs for gaming apps. After a while, the company did multiple acquisitions and has expanded its reach into a full-scale advertising platform, able to serve non-gaming apps and connected TV as well. So that's the background. So Adam Foreffi is the founder, and the company was started in 2012. He worked at a few other startups, but then he eventually gained enough expertise and passion about the app business. So they built AppLovin, where they were really just trying to build other apps for clients, but then realized it was actually distribution that was the problem for a lot of these apps. Since there were so many apps out there, right? There's an app for that, but they needed to get distribution. And so he realized that there was some value in creating an advertising platform in order to get these gaming apps out there in front of people. So that's the background. Headed to the business overview. AppLovin's business consists of connecting advertisers and publishers, mainly for mobile apps. The company owns or partners with 11 different mobile gaming studios, which have produced more than 200 games. This is a rich source of first-party data that the company has built up over the years, giving them access to millions of player profiles with granular demographic data. This allows them to go to advertisers with a strong ROI-based pitch. In the early days, most advertisers were also mobile game companies. Let's say you created a new Candy Crush competitor, but you needed to spread the word. You may use AppLovin's app discovery product to ensure you hit your installation goals. It's basically like Facebook Ads Manager, where you create your ad and then AppLovin does its magic and spits out downloads when you put dollars in. Eventually, as your app grows, then you could use AppLovin's Max product to do real-time bidding to ensure your user base monetizes at the highest rate possible. It's just like Google AdSense, where the publisher or the website owner wants the highest advertising dollars, while the advertiser wants the best ROI for their ad dollars. AppLovin fulfills this exact purpose, but mainly focused on mobile apps, though they somewhat recently moved into connected TV through their Whirl acquisition. Going back to Max really quickly, AppLovin acquired this technology through its MoPub acquisition from Twitter, now X, for $1 billion in 2021. MoPub allowed AppLovin to secure its place as the primary mobile app bidding platform for publishers. With its strong first-party data from 200 apps to satisfy advertisers, along with its formidable publishing platform, AppLovin has created an ROI competitive advantage. So basically, what Foreffi did was, since they had such a background in creating apps, that was a really rich source of first-party data, right? They had all of these apps that they knew exactly who was playing, the type of person, their age, some of these demographic data that they then used in order to improve their advertising algorithms. So now they show ads not just to their first party games, but to a bunch of different third party games. And so the real advantage was built based on all of these games that the company themselves actually built, which gave them a lot more granular data. And so moving on to the numbers. So the numbers are very pretty. Free cash flow margins were above 30% last year, and analysts predict that they could reach 40% next year. The software platform does 70% adjusted EBITDA margins, which are still likely to be above 50% even after backing out all the extra items like stock-based comp. Very few companies can grow revenues 30% with 50% free cash flow margins. The capital-light nature of this middleman business is incredibly scalable. With more publishers and more advertisers, ramping up is fairly easy with a self-service ad portal. The company's first-party apps business has declined by mid-teens in both of the last 2 years, which is a drag on the overall top line, but the software business is more than making up for it. While it's a little tough to get a perfectly organic growth number, the software business alone did grow nearly 90% in Q1. I'm sure the relatively recent connected TV acquisition is included in that number, but it's still very impressive. In late 2022-2023, the overall top-line numbers look very weak, but that was partly due to a weird accounting convention associated with the MoPub acquisition. AppLovin spent nearly $300 million to buy out all the publishers so they would stay on rather than leaving for a competitor. Since the acquisition broke the terms of the agreement that publishers had with MoPub, they were free to leave their contracts. So AppLovin sweetened the deal, and apparently over 80% of the publishers stayed. But this buyout was actually a contra revenue line item rather than expense, so it made the top line look much weaker than it actually was. All in all, AppLovin's numbers are pretty, especially when you take into account the software platform in isolation. I think the first-party apps business will always be around so they can sell the picture of differentiated first-party data, but the real cash flow comes from the software business. So when you're looking at AppLovin, there's really two sides. There's the first-party apps business, and then the software platform where they're doing the real-time bidding and connecting publishers and advertisers. So the first-party data and the games that they have created really isn't growing. It's actually declining. But the very, very high margin, fast growing software business is accelerating and growing very nicely. And so the overall top line is now accelerating because the software platform is a bigger percentage of revenue now. But if you were to just look at revenue, you'd think, oh, growing 30%, that's pretty good, but not amazing. But if you kind of dig one layer deeper, the software platform is growing really, really nicely. And so that's kind of what this section is talking about. So moving on to the market size. So it says advertising is a huge market. That's obvious. But I think AppLovin was pigeonholed a little bit into thinking they were just a mobile gaming advertising platform. But with some of its acquisitions, it has really built out a much fuller offering. Its non-gaming ad revenue is growing much faster than gaming revenue, and its non-app revenue is growing even faster than that. While it got its start in mobile gaming and has differentiated data in that space, the company is utilizing its reputation and technology to expand its platform. With this optionality, the TAM is plenty big, and the company has a lot more room to grow. So it started out just with gaming and mobile gaming, but now they have moved outside of gaming into other apps, different things like meditation apps or whatever it is. Any wants more installations on their apps will likely use AppLovin. And now they're not even necessarily focused on apps. They have the connected TV offering, and so it's becoming a fuller advertising platform than simply just apps through iPhone, iOS or Android. They're really broadening the platform, and so the market size is more aligned with advertising in general rather than just mobile game advertising. So moving on to the moat and competition section. The one competitor that everyone says to watch in this space is Unity. Its creator platform is a core part of the developer community along with Epic Games' Unreal Engine. Unity added on to its gaming engine by allowing creators to monetize their games through advertising. So they also have a very strong app advertising model. However, in the last year or so, Unity has really fumbled the ball. It started in September of 2023 when the company announced a new 20-cent per install fee for developers with over $200,000 in revenue. That seems reasonable until you realize that can end up being about 20% of revenue for a lot of developers. It's all about decreasing the cost per install since that is what you can monetize, and adding a fee like that just started an outrage in the developer community. The company has since walked back this decision, but the brand damage was done. I do think this is one reason for AppLovin's growth, just developers moving over to app discovery rather than Unity's advertising engine. It's hard to quantify this impact, but it's likely at least a couple percentage points. The company also competes with the large players, of course, like Google and Facebook. Yes, I know they're called Meta and Alphabet, but I'm old school. Developers can always run ads through these platforms to get installs. These companies are so valuable because, well, the ads work, so they're always to be mentioned in the same conversation as an advertising company. Further, Google owns Android, so it's very important for the app ecosystem in general. And of course, then you have to talk about Apple. When Apple announced IDFA, Identifier for Advertisers, it was the shot heard around the world in the advertising world. No longer would ad companies have the ability to track users at all times. Users now had the option to opt out of being tracked. This hit Facebook the hardest as it relied on third-party data across different apps, not just Meta properties. However, since AppLovin had a trove of first-party data, it wasn't hit quite as hard. But the point remains that the advertising ecosystem is always changing. Facebook has righted the ship by utilizing AI to make its ad algorithm stronger and commanding premium CPMs once again. Cost per 1,000 clicks. And AppLovin has done the same thing through its Axon 2.0 engine. It uses AI to match buyers and sellers more precisely to increase the revenue per install for publishers while decreasing CPMs for advertisers. So far, it seems to be working really, really well. It's sort of a black box, but management has attributed the new and improved technology to the reacceleration of the software platform's growth. So going through talking about Meta and Google is really important because the ecosystem is really built off of these companies, right? So if you want to download an app, you're going to either do it on your iPhone or your Android. There's really no other going to do that. And so even just somewhat recently, there was some worry with AppLovin about Apple. They announced a new developer SDK, a software development kit, at their big conference, WWDC. And when they announced this, it was a little bit uncertain for AppLovin because Apple is really moving towards more and more privacy. But it doesn't really seem like it's a big deal. It seemed more like a rebranding rather than changing the underlying mechanics. And so it shouldn't be a big problem, but it's always important to think about the changing landscape with Apple and Google because if they make it much more difficult for AppLovin to sort of target users, then that decreases the terminal value for AppLovin. However, because they have such strong first-party data, that definitely decreases the risk, but that's what this section is all about. Moving on to kind of related, so moving on to some more of the risks. It reads, we already touched on it, but being an advertising platform comes with an ever-changing landscape. Whether it's the deprecation of cookies on Google or IDFA, there is always something new happening in the ecosystem to strike the balance between privacy and advertising effectiveness. Apple is focused on privacy since it makes users feel better, and they don't quite care much about making boatloads of money for Meta and Google. Despite all the industry changes, AppLovin has navigated these waters pretty nicely over the past decade or so. Second, a more existential risk is the form factor of apps changing. If we do use VR systems more regularly, will apps be utilized to the same degree, or will the nature of advertising look much different? Or will AppLovin be able to squeeze itself into the new ecosystem? I imagine AppLovin would be able to adapt into the new form factor since it's just the advertising engine, but its first-party data might be impaired. I guess its app studios would just have to start developing games for the Vision Pro. That's the important thing to realize with AppLovin. The first-party business isn't a good business, but it lays the foundation for why the software platform can be a very good business. It's almost like there isn't a strong competitive advantage without the quote-unquote bad business. It's just so much easier to sell the software platform when customers know that there is first-party differentiation. And Axon 2.0 running on top of all that data is proving out why that's so important. Third, and to this in the next section, I still don't love the fact that the company has done so many acquisitions and they're willing to sell to Unity. It seems like the platform has been cobbled together, and that makes me worried for the user experience. However, if customers are flocking to use it, then those worries aren't super valid. So we're going to get into it in a little bit, but really what I see as the risks are, we already talked about the Google and Apple different privacy trends. So that's definitely one thing. And the second thing, which is a little bit more out there, but it's VR systems. So if we don't use our phones as much and it'll be more VR used in free time, then that could definitely impact the amount of time that we're spent on gaming apps specifically. But we'll see. That's a little bit out there, and that's more long-term risk. So it's probably not as important in the nearer term, but just something to think about for long-term investors. And then I'll save this last one for the next section. And so moving on to the management section, Adam Ferruffy owns about 8% of the company, worth just under $3 billion. So he is heavily incented. One thing I'm having a hard time getting over, though, is that AppLovin tried to buy Unity, and Ferruffy was willing to let Unity's CEO be in charge. The CEO at the time was John Riccitiello, who was accused of sexual harassment a few times, but ultimately had to step down because of the install fee fiasco at Unity. The fact that Ferruffy would give the reins to Riccitiello makes me nervous, since it seems like Ferruffy doesn't have the long-term mindset I typically look for. I'm probably butchering Ferruffy's name, honestly. I don't think I've actually heard it in person. As another piece of evidence, AppLovin tried selling the business in 2016 to a Chinese private equity firm, but the takeover actually got blocked by a US institution that was cracking down on Chinese foreign investment in the US around the time Trump was elected. The fact that Ferruffy has tried to sell the business twice, unsuccessfully, to less than stellar operators makes me nervous for the long-term vision of the company. Further, since the business has done so many acquisitions, I'm almost positive there's a good amount of technical debt to go along with the financial debt. But to speak out at the other side of my mouth, Ferruffy is a billionaire a few times over, and he is clearly a good business person. The fact that he wanted to sell but is still at the helm shows he's not quite checked out yet. And the acquisitions they have done have been pretty good. Getting MoatPub for $1 billion and deepening AppLovin's moat substantially is a perfect example of Ferruffy's savvy. So in this section, kind of going over the history of the company a little bit more and how they've actually tried to sell AppLovin twice. And so maybe AI really did change everything, where the algorithms are just getting so much better that they're just a cash cow now, and they didn't realize that previously. But it just makes me a little bit nervous that they'd be willing to sell out twice to what I perceive as inferior buyers. And so maybe it really doesn't mean much, but the fact that I think they don't necessarily know just how much of a crown jewel they have could either be, if you wanted to take the negative side, either be that they don't know their business as well or the industry, which I don't think that's the case, or the fact that AI really has accelerated things and they're just sitting on a treasure trove of data. That seems like the more likely explanation, but it just makes me a little bit nervous about the long-term vision of the company. However, the CEO owns 8%, so he's heavily incentivized and he's still there doing an amazing job. So these are just a couple sides of the coin to think about. Moving on to the conclusion, it says AppLovin is a very interesting, profitable business. Though it has a little bit of a complex background with large acquisitions and a big debt balance, the company has built a strong two-sided network. With its valuable first-party data as a selling point, its third-party software business is a cash flow machine. While I have a few concerns about management, I would be remiss to not marvel at the way the team has navigated regulation, competition, and its product suite. So that is AppLovin in a nutshell. And this was me reading through the business breakdown and just giving a few thoughts on each different section. But overall, I think AppLovin is a wonderful business. I mean, not many businesses can grow over 30% with 50% true free cash flow margins. So that's a rule of 80 business if you add the revenue growth and free cash flow margin. And typically a good business for software is 40%. So it's really double that. And the valuation is actually not that demanding because some of these risk factors. And so AppLovin is a very interesting business, and this is the business breakdown on it. Let me know if this was a good good format or if it was too boring or whatever. Just let me know. Feel free to reach out to me. But this is AppLovin in a nutshell. Thanks so much for listening.